Well, good afternoon. Happy Friday, March 21st. Mark Milam here, your mortgage professional. We'll get right to it. Not a bad week for mortgage interest rates, finishing out the week maybe about an eighth lower across most note rates as compared to where we start the week. We'll take that. Been a volatile series, though, as we pay attention to what's happening with the Fed, what's happening with Fannie Mae, Freddie Mac, and their regulator, the Federal Housing Finance Agency. First, let's get to what's happening with the Fed. The Fed did meet this week, and on Wednesday, they announced their policy rate decision, which was to hold the Fed funds rate steady, no cut to the Fed funds rate, and no hike to the Fed funds rate this week, and really forecasting the same thing they've been forecasting, which is 2 Fed rate cuts coming sometime this year, but not getting the impression that those rate cuts are coming anytime soon. Certainly not at this meeting. We don't project the next meeting as well. Even when you get out to June, there's a big question mark around it. More than likely, if we see Fed rate cuts this year, they're going to be coming in Q3, perhaps Q4 of 2025. There was one voting Fed member who voted for no cuts this year, which may or may not happen, but obviously that's an interesting thing to watch. We'll keep our eye on that as we go. One thing the Fed did announce was that they'll be tapering their quantitative tightening, and so when we start talking about the Fed's balance sheet, the Fed loaded up on treasuries and mortgage-backed securities during the pandemic and even pre-pandemic in order to keep interest rates low. They're no longer doing that. In fact, they're doing the opposite. They're allowing these treasuries and these securities to roll off their balance sheet as they reach maturity. Well, that's happening to the tune of about $20 billion per month for the United States Treasuries market, and the Fed has announced that they're going to be tapering that $25 billion per month roll-off down to about $5 billion. So that would tend to give a little bit more punch to the Treasury market. In other words, the Fed is going to be an active participant in the Treasury market, a little bit more to the good to keep interest rates suppressed. The same cannot be said of the mortgage-backed securities market. So with the mortgage-backed securities market, there's not going to be any quantitative tightening. And in fact, the Fed referenced the reason why is mortgage-backed securities are just not rolling off at that high of a pace. And this is kind of for obvious reasons. So many Americans are locked in at historically low rates. They're not paying off their mortgages unless they just reach maturity. Why would you be in a rush to pay off a mortgage when your interest rate is 2.5%, 3.5%? You've got an incredible inflation hedge. You may as well put that to use for yourself. But this quantitative tightening, this tapering of quantitative tightening in the Treasury market could still be well received in the bond market, and that does affect mortgage interest rates. So if we see that being well received with the 10-year Treasury, for instance, that's what mortgage rates very closely follow, then perhaps we'll get a little lift out of that. Remains to be seen, not going to go into effect until starting next month, and we'll keep our eye on that. What else is happening? Well, the Trump administration, no secret about what they have planned for Fannie Mae and Freddie Mac. We know that there's a privatization move underway for Fannie and Freddie. With a timeline for this is uncertain. How private will it be? What kind of governmental support will it still have? Boy, all these questions are not really readily answered. But we have seen the CEO of Freddie Mac, the COO of Freddie Mac, the HR director, the COO and the HR director of the Federal Housing Finance Agency all lose their jobs this week. This comes from the new acting head of the Federal Housing Finance Agency, Bill Pulte. If that name sounds familiar, he's part of the Pulte home building legacy. And so all of this creating some turmoil and some volatility within the GSEs, the government-sponsored enterprises of Fannie Mae and Freddie Mac. And that volatility could bleed over a little bit into the interest rate environment, especially if the move towards privatization happened. And we have seen the government order stress tests among Fannie and Freddie to verify how well financially healed they are and how they are able to withstand economic turmoil. So that will be an interesting thing to watch as well. Also, if you didn't catch this, and I'll just throw this out there as sort of a sign of what's happening economically. So this is a publication from January the 10th, 2025, where Delta Airlines Outlook topped estimates as CEO expects 2025 year to be the airline's, quote, best financial year in our history. That's dating back to January 10th of this year. Fast forward about 60 days here to March the 10th. Let me flip the screen back around here. To March the 11th, Delta cuts profit forecast as U.S. economic uncertainty hits travel. Essentially, what we saw here over the past 60 days is Delta going from, hey, we're about to have record profits in our best financial year ever, to, hey, we're cutting all of that forecast down, and it's only been 2 months time period that has passed. That's how volatile and how rapidly our economy appears to be changing. When you take a lot of the support that the government has provided in terms of job creation and stimulation out of the equation, you start to see headlines like this, and we can see that the economy is sort of groaning under the weight of the changes that are happening. And we'll have to see how this plays out over the next couple of months. We'll be watching inflation, we'll be watching labor, we'll be watching consumer spending and borrowing as we move from Q1 into Q2. If I can be of any service to you over the weekend, don't hesitate to reach out. Mark.Milam at HighlandMTG.com. Have a good weekend.